Big tech bouncing back in a big way from New York City this morning. Good morning, good morning. The Nasdaq flying. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
From New York, we begin with the big issue. Big tech bouncing back.
The mega cap tech companies.
How resilient.
Stunning results.
Alphabet, it's a real bellwether for the whole industry.
That's obviously giving some comfort back into that portion of the equity market.
Technology is one of our favorite areas.
Quality companies with strong balance sheets.
We're going from a year last year of a trifecta of tailwinds.
We're at a turning point.
Rising rates.
A sea change in terms of Fed policy.
NASDAQ.
Sell-off that we have seen. These are dips worth buying.
It just requires, again, a more careful look through some of these names.
Joining us now to discuss JPMorgan's Meera Pandit, Hightower's Patrick Fruzzetti, and Chris Harvey of Wells Fargo. Meera, I want to begin with you. Is this a move, this bounce to the Nasdaq, that you've got some confidence in?
I do have some confidence in this move. I mean, I think that the re-rating we saw in the beginning of the year had everything to do with this rapid rise in rates, which tends to hurt some of the growthier areas of the market. And we did start earnings season off with a bit of a rocky start in some of the reports, but we're starting to see things pick up. And ultimately, these are companies that do have access to some of these long-term secular growth stories. As growth slows in the second half of the year, investors are going to need growth in their portfolios. And these are some of the interesting core holdings.
Chris Harvey, I smiled when I saw your name in the rundown for this morning. I smiled because we had a good laugh last week about the technical language you used, the cathartic puke in big tech. You thought it was time to buy the dip. It's delivered in a big way over the last few days, Chris. Why the confidence for you?
Why the confidence for us is we were expecting a 10% pullback. You had a lot of froth in the market. We weren't worried so much that systematic risk is so high, there's no price for risk. What we were saying is you needed to reprice risk. You did that. We're seeing, and what we've been saying for a long time is you just have to be more selective. The whole market's just not going to go up en masse. And at the end of the day, the fundamentals are still okay. And you can make money on this market, especially when you get a 10% pullback.
Chris, you've said the upside is limited. Can you frame that for us as we look through the rest of this year?
Yep. Yeah, John, again, it gets back to last year. Last year was a fantastic year. You had monetary accommodation that was through the roof. You had fiscal accommodation was through the roof. You had a recovery like nothing we've seen before. And now what we're doing is we're reversing a lot of those things. Fed policy is going to become more aggressive. We don't have the same fiscal policy that we had. Growth is decelerating and valuations are higher. You shouldn't expect the same type of returns. You really need to manage your risk. You need to manage your growth expectations. And you need to manage what you get from your portfolio. There's just not the same upside that we've seen. Right now, we think there's 3-4% upside right here, right now. And we would be buyers. Again, we'd be buyers on a pullback, but we wouldn't be chasing things.
This year, as you've said, is a year potentially for multiple compression. I want to come to you on that, Patrick. This is a difficult one to answer. I get that. You don't have a crystal ball. But to what extent do you believe that we fully discounted the Fed's move this year?
I don't think we've fully discounted it. And frankly, I think the move that began in January will resume. We've had a little bit of a head fake rally here. I think the move from growth to value will resume trend. I mean, we had inflation hitting 7% for the first time in 39 years. Look, I agree with Chris that you have to be selective for sure. But, there's really way too much noise in the market. And if you filter through it, you just know that the Fed, is really trying to set inflation expectations. Frankly, this talk of 4 or 5 or 6 rate hikes, I don't think ultimately comes to fruition. I think they'd be lucky to avoid a major market crisis if they actually went through with that. They know they can't do much from the supply side, but, in the end of the day, investors are looking at cash flow. And, when you look at the rise in commodity prices, if you look at things like the energy sector and raw commodities, ag commodities, everything's continuing to move up. I mean, just this morning, I know there's a major storm moving through the middle of the country, but nat gas futures are at 530. Brent crude is above $90 a barrel. I don't think that that's anything that's going to change in the near future.
WTI came really close to a 90 print as well a little bit earlier this morning. That's at 89.15 right now. This rate hike game continues. At the front end, I've got the likes of Barclays at 3. At the very back end of the conversation, I've got Bank of America at 7 for this year. The St. Louis Fed President Jim Bullard basically said maybe 5. He said the following: the markets are pricing in 5. I think that's not too bad a bet right now. 50 basis points, I don't think help us. Mike McKee, I want your thoughts on this. So 4 or 5 seems to be where the Fed speak is at the moment. 50 basis points, not right now.
Yeah, not right now. They're pushing back on that. Some prominent folks on Wall Street, and you know who you are, suggest the Fed is behind the curve and will have to be aggressive and maybe even raise 50 basis points, which is a strategy that's now been embraced by absolutely no one on the Federal Reserve. You can see what they've been saying the last few days. 6 members of the Fed speaking. And basically, I don't have to read them all for you, but basically the idea is that they have to be data dependent. They can't define a path right now and just stick to it, is what Philadelphia Fed's Pat Harker told us yesterday, because Fed doesn't know exactly what's going to happen with Omicron and the economy going from here. As you mentioned, top Wall Street banks also, it seems, in competition with each other to try to outguess how many times the Fed will raise rates this year. Fed officials say that, too, is a mistake. The reason is COVID. They thought they had a plan for the economy. They thought they had a plan for inflation. Then came Delta and Omicron. So what are they going to do? They're going to watch the data, as they say. Wall Street will have to as well. They will be data dependent. Here are some of the key numbers to watch. Payrolls come up twice before the next meeting, including on Friday. CPI a couple of times. We get a PCE report, retail sales, and ISM services. We're going to have a little trouble trying to decipher what happens with payrolls because we're expecting a very bad number on Friday. The ADP number today comes in negative 301,000, again, because of Omicron. And so the Fed's going to have to take that into account and take into account the fact that the following month will probably be even more confusing because there'll be a big rebound. Right now, we're looking at that range, John, you mentioned 250,000 positive to negative 400,000. I assume that is going to change and maybe move more towards the downside.
Well, let's talk about the downside. And Mike, thank you. Let's talk about those numbers. Negative 150 is the number, the estimate coming from Bank of America. They still think you get 7 hikes this year. The estimate coming from Wells Fargo, negative 100K. They still think you get 5. Goldman believe you get 5. They're at negative 250K for this coming Friday. Nomura at negative 50K. They believe you get a 50 basis point hike in March. I think for a lot of people, they believe this number just does not matter. Brian Deese of the National Economic Council for the White House, I think he agrees.
We never put too much weight on any individual month. This will particularly be true in this month because of the likely effect of the short-term absences from Omicron.
Meera, I want to come back to you and get your thoughts on this. Does that Friday print matter or not?
We could very well see a negative print on Friday and probably a challenging print for the January number as well, given some of the Omicron challenges. But I'm not sure that that's going to be the data that skews the Fed into a more dovish direction, because ultimately, a lot of the measures that they're looking at, whether it's quits or job openings, are still incredibly tight. We do have an overall tight labor market. And ultimately, with 7% inflation, that's really the number that they're paying attention to more.
Patrick, what will you pay attention to this Friday?
Yeah, look, I don't think the number is going to mean too much, quite frankly. I think the 6th straight month of 4 million people quitting their jobs is important. The fact that there's a record 10.9 million job openings in the country. I think those are the things that the Fed is going to focus on. I just think they're going to have to be very careful, in these rate hikes. 50 bips, as a first Fed hike move, I think would be absolutely ridiculous. Again, unless they want to create some major volatility in the markets.
2 CPI prints before that March number. I mean, I'm not on board with it either, but you never know. You never know. Neil Dutter of Renmax saying this: you have to treat the January jobs number as a very bad weather event. Payroll growth is delayed. It's not derailed. Chris, there's a consensus here going into Friday. I understand it. Most people do. There is an issue here, though. Consumer sentiment's not exactly great right now. You're making the point that you think peak pricing power is behind us. Are we going to see a demand hit off the back of some of this?
Yeah, John, let's just talk about the Fed for a second. And just on Friday, what we think is you've just seen the biggest sick out of your entire life, your entire career. That's all that is. Now, with regard to the Fed, I'm not sure where I stand at this point in time. A few weeks ago, there was nothing to see here. And now Powell is Mr. Inflation, and we're talking about 5 and 6 and 7 hikes. It's a little odd. And the other thing is we're seeing break evens come down. Chinese New Year has occurred, so the flow of goods into the U.S. is slowing down, right? If we're going to make some headway into the loggerheads in the supply chain, now's about the time you would do it. We have, the phrase, the other catchphrase we use is the U.S. consumer is spent like a drunken sailor post-recovery or post-pandemic. A lot of that demand has been satisfied. There's not a ton of pent-up demand left at this point in time. So it's not clear to me what they're trying, what's motivating them. And maybe the only plausible argument I can really understand and stick my teeth into is they're attacking a behavior. And that behavior is we're very worried that people believe that prices will continue to move higher. We're worried that people believe that we'll always have higher wages. And we want to break that belief. Because a lot of the things that we're seeing is we're seeing the economy slow down. We're seeing a crack in break evens. We're seeing possibly a pause or some improvement in the supply chain or potential improvement in the supply chain and some belief that maybe the worst is behind us, right? Not that it's going to get better anytime soon, but maybe we peaked. So I'm a little bit not confused. I'm uncertain about why. And if it is because of that mentality, okay, great. If there are other things going on, I am not really sure how this is going to work out. If you're going to raise 5 to 7 this year, you're going to slow down the economy. You're going to slow it down greatly, and we really have to be concerned.
Chris, does that make your market call harder?
No, it actually makes my market call easier because we're only expecting 3-4% upside from here. And what I think is we could possibly we could rally. We are rallying. We could rally a little bit more. That doesn't mean that we're going to hold those gains. If the Fed does get more aggressive, maybe we don't hold those gains. And maybe we get another opportunity or bite at the apple, right? And maybe as they slow things down and they realize that we've had peak congestion, right? Maybe they start messaging to the market that 5, 6, 7 is a little bit too much in the second half of the year. Then we can start to have a better environment. And the last thing I would say is it looks like we're going to have a very aggressive sweep. It's going to be a red sweep this time. And the Senate, that moves from Democrat to Republican, is usually pretty good for the market. So we do have some catalysts in the second half of the year.
We can build on that in the second half of the show. Chris, stay close alongside Patrick and Meera. Sticking with us. Let's get you some single names. We have got to talk about this move in big tech. It's led by Alphabet. Here's Abby with more. Hey, Abby.
Hey, John. Well, it's really pretty incredible. Alphabet absolutely crushing it, as one analyst at BMO said. The stock now up more than 9% in the pre-market, on pace for the best day since March of 2020, just below 9% at this moment, fluctuating around that big number. And they, of course, put up a big quarter around all of the segments, 25% growth in every business. Top and bottom line results beat. Search and advertising business, super resilient. This pandemic strength sticking around, at least for Alphabet. And they're also doing what Apple and Tesla did back in 2020, or a stock split, the optics of a lesser amount of a stock, in this case 20-1. As we know, it doesn't change valuation, but to some retail investors it could make it more attractive. And of course, John, we have all the other mega cap names getting a nice sympathy lift. Big results there.
Abby, thank you very much. Coming up, corporate America starting to find its footing amid rising cost pressures and persistent supply chain constraints.
Supply chains around the world are very constrained, and it is a difficult supply situation. The uncertainties are going to be here I foresee it into 2023, actually.
Still ahead, the perfect guest to discuss this with, the GM chair and CEO, Mary Barra. That conversation coming up. With about 17 minutes out until the opening bell, there is a big lift on Wall Street this morning, led by Alphabet. Google absolutely surging. Equity futures up 0.6% from New York City this morning. Good morning. For our audience worldwide, the opening bell just around the corner. 14 minutes away from the opening bell in New York City. There is a lift to this market, a nice lift on the equity market, on the S&P 500, pushing higher on the Nasdaq by much more. On the S&P up 0.6%. With your movers, let's get across to Abby. Hey, Abby.
Hey, John. Well, let's take a look at the shares of GM and other automakers because we have a nice lift there as well. This, of course, after GM put up a very respectable quarter relative to profit beating. But I think it's probably the outlook that investors are so excited about. Outlook is very strong in terms of the growth expected for 2022. They're looking for 22% unit growth in 2022 on pent-up demand. But the big focus, or one of the big focuses for many investors, of course, is the electric vehicle, their push into EV. And what a push it's been. They are looking to spend $7 billion on battery supply expansion. That's $14 billion since 2020. But what really stands out is their goal to produce 1 million electric vehicles by 2025. That, of course, is Tesla's current goal. Chomping on the bit, chomping on their heels there, John.
Abby, thank you very much. We've heard from the chair and CEO, Mary Barra. This was the quote that jumped out for us all. With an improving outlook for semiconductors in the US and in China, we expect our 22 results will remain strong. There's been a big lift to the outlook on volume. Maybe some visibility coming through on the chip supplying issue, and that's what we need to get our teeth into in just a moment. That's going to be a big issue, not just for GM, for the whole industry in 2022. I'm very pleased to say that joining us now is the GM chief, Mary Barra. Mary, fantastic to catch up with you. I want to whip through the Southside research off the back of these numbers. Dan Ives Wedbush, buy. Laying major groundwork for a game-changing EV strategy. Citi, a positive outcome. It increases our conviction, buy. Jeffries and Philippe Houchoir is a little bit more balanced on this. He seems surprised by the volume guidance. 2 to 3 times bigger than what they'd heard going into this. Where's that coming from, Mary? Where are you getting that visibility from?
Well, as we look at the year, we've been working closely with the semiconductor manufacturers, our tier ones, to make sure that we, have the best possible forecast for what we're going to be able to build this year. Recall last year we were hit a bit hard with some of the COVID impacts in Malaysia, so that's where we see, the opportunity to see on a global basis, greater than 25% increase from a production perspective, and that is assuming that we're not going to have any, dramatic changes from a COVID or a supply chain perspective, but we feel very confident. And also what's exciting is we know there is strong demand for our vehicles. So I think 22 has the opportunity to be a very good year.
I want to hit that demand story in just a moment. Clearly there's a balance at play through last year, and you nailed that balance with the stock performance we saw. A balance between the chip access and pushing it towards the higher priced vehicles. Now it's almost the opposite. And I think there's some disappointment around that, Mary, that you get the better access, you get the better volume, but the average price comes down. How do you balance that? How do you optimize the balance there for 22?
Well, again, we had record performance this year, and again, hats off to the GM team with all the work that they did, the challenges that they overcame. And as we get into next year, not only are we going to be selling across many more segments. Last year in 21, we focused on our most in demand and capacity constrained vehicles. So as we open it up to, other allocation to chips to other products, it is different from a profitability perspective. And we also are investing in growth. And so, we're investing for the future. We know there's a huge opportunity, not only from an EV perspective, an AV perspective with Cruise, but also across the board from a software perspective, whether it's ICE or EVs. We see an opportunity to really grow from a services and subscriptions perspective.
Mary, you've got to help me with the numbers when it comes to CapEx and investment. The numbers we've seen in this industry are just huge. The team here at Bloomberg came out with a story. Ford yesterday throwing another $20 billion at this transition. You said, quote, we're going to be increasing spending. That much is clear. Is the answer always going to be more when you're asked how much you need to throw at this story, Mary?
Well, we've already announced between 20 and 25 that we're going to invest $35 billion, and we've been investing that big announcement last week in Michigan, $7 billion for conversion of a plant to build trucks, EV trucks, as well as our third battery plant. We're pulling ahead our fourth battery plant. We'll be making that announcement in the first half of this year, as well as an additional EV truck plant. So we're seeing the demand for our products, and we're seeing customers' willingness to adopt EVs. That's what's causing us to pull ahead. We're going to continue to do that, and we've got the capability to do that. And you'll just see our number grow as we continue to invest in EV and AV capability.
Right at the end of the call yesterday, you talked about the dividend. Mary, where is it? when does this dividend come back? What do you need to achieve to bring that back into play?
Well, we've had a capital allocation framework for the last several years where first we invest in opportunities to generate a return on invested capital of greater than 20%, as well as have an investment grade balance sheet and then return the rest to shareholders. And that's what we plan to do. But with all the opportunities we see in front of us to accelerate on EVs, accelerate AVs, and accelerate the software-defined vehicle, we want to make sure we have maximum flexibility. And that's why we're not reinstating the dividend as we currently assess the situation. There still are other mechanisms to return value to shareholders, but we want to have the flexibility to really support our growth.
Do you think buybacks make more sense? Is that what you're trying to say there?
Well, again, I think there's three pillars of our capital allocation framework. To me, making sure we're investing in creating value and growth, I think, is the best thing we can do for our shareholders. But if, at the end, we have excess capital, we are going to use one of the mechanisms to be able to return that to our shareholders.
You've mentioned demand a few times. Let's go through the numbers. The numbers are staggering. You've talked about this pent-up demand in the American market of several million vehicles. On the EV side, I was looking through the orders, the reservations, 59,000 Hummer EVs, 110,000 electric Chevy Silverados. I'm sure that if you open the books again for some of these names, they'll go again. They'll go again. Mary, have you ever seen demand this great in this country for this transition?
I just am really encouraged by how much interest there are in EVs. I really, last year, we started to see a tipping point. And that's why last year we really, and in 20, we started accelerating our push to EVs. And, we're uniquely positioned from a traditional OEM because we have the Ultium platform that we started working on several years ago. We launched the first vehicles off of it last year with the Hummer. And so that's enabling us to move quickly, but also have scale from a battery perspective that will, I think, give us a really efficient margin as we make these transitions. So I'm very enthused with the interest in EVs, the reservations, as you say. And I also think it goes to the fact that our products, our EV products off of Ultium, offer a lot of advantages from a range, from a performance, flexibility. So this transformation is pretty exciting.
I can tell you're excited about it. I can tell you're excited about the margins. I can tell you're excited about the demand. Here's the delicate question. Why does this industry then need credits, need tax credits?
Well, as you look at EVs, we do need to get customers into electric vehicles. We've seen that the incentives do help drive EV adoption. And remember, we have aggressive goals from frankly, a country perspective and a global perspective from what we need to do for the environment. So we think that will help, especially as all companies work to get battery costs down. I don't think it's a forever thing, but I think right now to get where we need to go from a market perspective, from a climate change, it's appropriate to do. What we're asking is let's make it a level playing field. We were a first mover. We're already out of today's credits, and we're saying let's uncap them so customers can truly buy what they want.
When you say make it a level playing field, what do you make of the extra credits going, if this was implemented and pushed through by the White House, what would you make of the extra credits going to companies that are selling cars made with domestic union labor? Does that sound like a fair playing field to you?
Well, again, every workforce has the right to unionize, so it's a choice that they're making. We're at General Motors. We're represented in the United States by the UAW and unions around the world. We've done a lot of great work together. So, again, every company can make their choice, and the workforce can as well.
Well, the White House has got to make a choice too, and you support it. I want to go through these credits. They're pushing for a $4,500 additional credit for vehicles that are made using domestic union labor. You get an additional $500 for manufacturers that use domestically produced batteries. And Mary, one thing that I've been confused by is why the push here? You've just gone through the demand story. It sounds fantastic. You're excited about it. I see the same thing at Ford. I don't see a demand problem here. I see an infrastructure problem, which the government could be focusing on. Mary, why do you think we should be focusing at all on tax credits? You sat in the White House in the last couple of weeks and you supported that. You said getting strong demand is very important, but we have that demand. So, Mary, again, why should we be focusing on that in any way, shape or form?
Right. Well, I think what we're looking for is we have strong demand, but when you look at how many EV sales there are today, we're in the single digits. We need to, by end of decade, to get to 50%. And so that's where you've really got to have the right portfolio. That's what we're working on. But you've also got to, move the customer and get their interest. And so to get to the levels of adoption, we're just in the early phases right now. And I think that's important. Also, infrastructure, EV charging infrastructure is very, very important. And the bipartisan bill that was passed for infrastructure, I think, is going to move the infrastructure along with what startup companies are doing. We're investing about $250 million in charging to make sure that any customer, even customers that only own one vehicle, know that they can count on their electric vehicle for their daily drive.
Mary, as you know, little mention of the Bolt EV in your letter. Some people have been raising a question as to whether that whole project gets canned as you retool your plants around the country. Mary, you're committed to that. Why does that still make sense?
I'm sorry, could you I couldn't hear your question.
Sure, just on the Chevy Bolt, just on the Bolt itself. There's been some problems there, as you know. Some people have raised the question as to whether you should just ditch the whole project and focus on what you've been doing subsequently, which seems to be attracting massive demand. Why does that push there still make sense?
Well, first of all, it's a great product. I was most recently driving a Chevrolet Bolt EUV, and it's just a peppy vehicle, fun to drive. Our customers that have bought Bolt EVs or EUVs are some of the most satisfied customers in industry, not just with a GM product. So it's a great product. We had a very specific issue with LG, our manufacturer of the batteries. We have worked with them. That's been corrected, and we're seeing strong interest. And so that the Chevrolet Bolt EV and EUV will be a very important part of our near-term future for EVs.
Have you got an EV market share goal for this year, Mary? What is it?
Again, I'm sorry, you're coming in muffled. I'm so sorry.
That's okay. I'm happy to repeat myself. Don't worry. Do you have an EV market share goal for this year? And if so, what is it?
We're working between 22 and 24 as we accelerate vehicles to sell 400,000 or plan to build and sell 400,000 vehicles by the end of 2023. So, and that's just going to ramp up from there. So we're very optimistic about the strength of our products. And as we build them, again, we're seeing with the reservations they're sold. So that's our goal for the 22-23 timeframe.
A final question from me. You've also taken the helm of the Business Roundtable in America too. For you personally, what are the big goals there for you?
Well, again, I think business, when we look at the transformation that's happening in almost every industry, I think business working together and also being a partner to move the country forward is very important. So I'm very proud of my BRT role and representing companies as we look to move to the future and, really create a stronger country. So a really important opportunity, and the work that BRT does is so important, so I'm honored to be able to have the opportunity to lead them.
And we're honored to have you with us this morning. Thank you for being with us. Looking forward to catching up through the year ahead. The General Motors Chair and CEO, Mary Barra. Looking ahead to the opening bell, this is the situation for you about a minute out. There's a big lift in this equity market. On the chip supplier side of the story, GM giving you some hope for the year ahead. For Alphabet, just the cyclical appetite for ad revenue, for ad spend seems to be absolutely fantastic. Ad revenue there up by more than 30% for the quarter in Google. That's given the NASDAQ 100 a major lift here, up by 171, up by a little more than 1% on the NASDAQ futures. On a Russell, up by just 0.04%. On the S&P 500 futures there, positive 0.5%. If you switch up the board and get to the bond market, here's the story for you going into payrolls. Ahead of payrolls, we could get a negative number after what we've seen on the ADP report. Treasuries settled down at the moment at 179, 178.76. Yields going nowhere. Euro dollar one to watch. Inflation in with a 5 handle. We did not expect that. The ECB coming tomorrow. Full coverage here, of course, on this program. Euro dollar 113.18. And crude up by 50 cents, up 0.6% to 88.74. That is the cross-asset price action. The downgrade starting pretty early this year. Ed Yardeni, the first one out the gate, trimming his S&P 500 price target to 4,800 from 52, writing, quote, Chair Powell and his colleagues have been making the tough transition more painful. My message to the committee, the labour market is strong. Inflation is a problem. Can we just get on with what needs to be done, please? Chris, I want to bring you back in. You raised the point, what needs to be done. You're confused by what they think needs to be done. Run me through that again.
Right. Yeah, so we were really worried about inflation 6 months ago. What we said is, or what I've said is, we had never seen the kind of pricing environment we had seen in the first 6 to 12 months of last year. I turned to my analyst in the summertime. I said, give me 3 stocks that are raising prices. I said, Chris, pick any 3 stocks. And what we were seeing from the consumer is the consumer didn't care about price, right? There was no, you could raise price, and we joked around about this. You could raise price 10%, and the consumer would say, I'll take 2, you know what, make that 3, okay? And that's when you should have been attacking it. But what we were doing is we were still buying bonds at that point in time. We were still adding accommodation. It's odd, okay? Now what we're seeing is we're seeing a normalization of the consumer and the consumer spend. We're seeing inflation and inflation expectations come down. Maybe we've seen a peak in the supply chain. Maybe we've seen peak supply chain issues. The other thing that I've been trying to say rather ineloquently is it's not just about supply, it's also about demand. We saw retail sales go up 20% from the pre-pandemic peak in about 20 months. It took years post-financial crisis to do that. So I'm not sure why they want to accelerate everything right here, right now. And what I'm worried about in the past is they've stuck around too long. They stuck around with the taper for too long. They stuck around in 18 for too long. And maybe they will do 5 or 6 or 7 hikes and tell you that we really have to take this mentality out of the marketplace. I don't know, but the economy is already slowing down. If you're going to attack it with higher rates, you're going to shrink the balance sheet. You're going to have a big effect. And part of it is where we came from. You threw so much stimulus at the situation last year and for the last 2 years. It's going to be in stark contrast. And I'm not sure, if you get really aggressive, I'm not sure how well the market can take it.
The Nasdaq move up 0.6 on the Nasdaq in early part of trading, up about 3 minutes into the session, up about 0.6%. On the S&P, up 0.4%. Meera, I want to come to you. PayPal's getting absolutely hammered. Alphabet's doing really nicely off the back of earnings. When you look at tech, how selective do you want to be at the moment?
You definitely want to be reasonably selective at this point. I mean, a lot of the easy money has been made in 2020 and 2021, and we saw an enormous rally. So we certainly want to look under the hood to understand those profitability trends. Now, a couple of mixed reports don't necessarily mean a company is no longer viable in a portfolio. We can expect that reports increasingly will become a bit more mixed as we head from this heady phase of recovery to a more recovered environment. But nonetheless, I think we do need to re-underwrite our positions, and we're probably not tossing a lot of them out. You know, we keep the best and we leave the rest, but certainly being selective and active in this environment will be important.
Patrick, your thoughts on tech right now?
Yeah, I don't find many of the high multiple stocks very attractive. But I will say anything that kind of falls into the payment space is interesting just because there's been so much volatility from the highs in that space. So if there's any area we're looking at, it would be there. But, you know, quite honestly, I think, you know, Chris was just mentioning this, you know, every time the Fed has tried to tighten or frankly ease less, you know, in recent memory, you know, the market has just met it with unforgiving action. Right. And so, you know, I just think there's going to be more volatility in the months ahead.
Google looks good. 4 minutes in, we're higher on Google, on Alphabet through much of this morning. Let's turn to Ed Ludlow on the West Coast in San Francisco for more. Ed.
Good morning, John. Yeah, strong beat, top and bottom line. And this is broad-based growth driven by search, right? 33% ad sales growth overall. And you have to remember that the fourth quarter ending in December was the Omicron quarter, right? And the two mainstays of search are travel and retail, but not a problem. It seems to have done well. Cloud business doing well. John, I don't know if you're into TikTok. I don't think you're a TikToker, but did you know that YouTube has an equivalent product called YouTube Shorts? And it's interesting because they hit 15 billion daily views on that platform. So there's growth in YouTube as well, although they did miss YouTube in terms of sales estimates. And one worrying concern is, of course, that YouTube is the most sensitive of Google's portfolios to those ad tracking changes made by Apple. But let's get to the real news, right? The stock split. And the rationale here, according to Ruth Porat, CFO, speaking to Bloomberg, is making this stock more accessible. 20-for-1 split, okay? Bringing, you know, the shares roughly to $138 a share based on Tuesday's closing price, issuing 1/10 cent for every Class A, B, and C stock out there. So this is interesting. And I thought that the thoughts of Brian Novak at Morgan Stanley were most interesting, that this puts pressure on Amazon, right? There's this intense battle right now for capital. Alphabet and Google aren't just doing the stock split. They're being more shareholder friendly generally, right? Disclosures, shareholder returns, splits. He wants to see that potentially happen with Amazon, for example. Stock splits have been out of vogue since 2007, 2008. Now we have this comeback driven by Apple, by Tesla, and more recently, Alphabet. And now who else else is on the up today, John? Meta platforms. So you want to see how much does how much does this translate to a broad read on the ad business and by extension the macro picture as well?
The stock split conversation drives me nuts, and Tom Keane knows that better than most, and you know that too, Ed.
Yeah.
Amazon in focus, I'm sure, a little bit later this week. Don't apologise. The stock's doing lovely off the back of all of this, up by 9%. You had a great story out yesterday, Ed, just on the Ford spend.
Yeah.
It's interesting to me that Dan Ives of Wedbush is now covering not just the tech names, but also the likes of GM and others. Ford have thrown another $20 billion at this, Ed. When's enough?
Yeah, it's really interesting because it took a long time for the street to kind of give GM and Ford credit because they're balancing the shift from combustion engine to EV. They don't start with a blank slate like Tesla did. As you said, sources told us that this is $20 billion on top of $30 billion already stated. And Tesla is the roadmap. You know, sources telling me that Farley sends Tesla articles around internally to execs and team members saying, guys, look at this. This is the roadmap. But we are getting serious now. I really enjoyed the comments of your guest previously. Delivery, right? Mary Barra says 400,000 next year. How many this year? You know, what is the near-term, medium-term roadmap?
Ed, this tax credit story is so controversial, especially if you're Elon Musk, and I do want your opinion on it, your view on it as you report on the subject, on the topic. It does not seem to me that we've got a demand problem in America for these vehicles. There seems to be massive demand. At the same time they show off the order book and the reservations, they're also lobbying the White House to offer more credits, and I just don't get it, Ed.
Yeah, I think that this is a supply-constrained industry, right? If you go on Tesla.com right now and you want to buy a vehicle, you'll wait until July in the higher-end models and almost a year out to December for others. When Ford talk about why they haven't given hard long-term deadlines, they talk about the consumer credit angle of it, or the consumer incentive package of it, because that will be a further driver of demand. Like, these are vehicles for higher and middle-income families. Not everyone spends 40 grand on a vehicle, John, in America. And so I think that that's the tipping point that folks are looking to. When do we go sub 30? And then that opens up to America that need a single-family car, and incentives are really closely tied to that, based on what I'm reading.
That's a really important final point, Ed, and thank you for it, sir. As always, Ed Ludlow on the West Coast. Meera, I want to come to you on this big EV transition and where to play it after we've seen massive gains for the likes of GM Ford in the last 12 months.
Look, electric vehicles, like vehicles in general, are very capital intensive, and this will be a space that we are in the early innings of. There will be a few winners and a number of losers. I mean, if we think about where we are 100 years ago with the internal combustion engine, there were something like, hundreds of car makers, and now today there's 3, 4, 5 prominent ones in the United States. So it definitely lends itself to consolidation over time. Right now, we'd think up and down the supply chain when it comes to EVs, though, not just the cars themselves, but the batteries, the technology, the infrastructure required for the charging stations, the commodity inputs. There are a number of ways to access this trend without necessarily going into some of the names with super high valuations and without dependable production.
Meera, build on that, because for many people who missed the run-up in the car names, the auto names through much of last year off the back of this big transition push, they might feel like they've missed it, and they're trying to work out the pockets of the markets that still have a decent entry point. Can you be more specific across the whole chain that you just described, where you think that is right now?
Sure. I mean, I think that among the producers, some of the names that are entering the market that already have a track record of production, either in the EV space or more broadly with cars in general, and have that technical know-how, may be able to scale up a lot easier than some of the brand new names that don't have this production track record. But if we think about some of the broader elements of the supply chain, certainly semiconductors is a long-term area where we're going to continue to see investment, not only for EVs, but a number of other applications, whether it's AI or robotics. So having that multiple strands of applicability will be really important. And I think that also from a commodity perspective, commodities tend to be very volatile. We want to be very careful about what we own, but there's some green shoots here, given the fact that this will be a very commodity intensive transition.
I've mentioned Dan Ives of Wedbush a couple of times, so let me bring up the quote just quickly. Alphabet delivered a Joe Burrow-like robust quarter, further boosting the confidence of tech investors. The bears will now go back into hibernation mode. If you're outside of America and don't know who Joe Burrow is, former LSU quarterback, now of the Cincinnati Bengals, goes to the Super Bowl. Chris Harvey's so proud of me right now. Chris, let me turn to you. Can the Bears go back into hibernation, Chris?
I am really proud of you. Here's what we would say on tech, and it's true, and we've been saying this for a year, and it's true for all stocks across the board. If you're looking at things on a multiple of revenue, that's not where we want to be. We don't think those stocks really work. Yes, they're going to bounce. They are bouncing. If you're looking at stocks on a multiple of earnings, then we can have a conversation. That's where we think the opportunity is. We think a lot of companies that are growth at the right price have really derated here. We think there are a lot of companies with good secular pricing, as we talked about with pricing. Not everyone's going to have pricing going forward. And what we want is just really good risk rewards, whether that's in tech, whether that's in consumer, or in financials.
Patrick, final word, sir.
Yeah, I just wanted to mention one thing that Mary Barra mentioned, and she, in this tremendously strong CapEx cycle where they've been spending a lot of money and talking about capital allocation and not reinstituting a dividend, I think companies for the past 10 years hadn't been rewarded much for, either instituting or growing the dividend much. I think that's changing. And so I actually think that that could be something, by next year they may quickly revisit that policy.
Patrick Fruzzetti, good to catch up. We're going to build on that story. Meera Pandit, thank you to you. Come back soon. Chris Harvey as well. He's so proud of me. Thank you, Chris. We've made up after all this friction over the last few years over his price targets. Coming up, the White House warning on payrolls.
The survey was done roughly around the week of January 12th. There were millions of people that were still not in work. A lot of them were out sick. Some folks were out sick. Right. And if they were not eligible for paid leave, they're going to be marked as not working when in fact they are.
A really important chat coming up ahead of payrolls. That's next. This is Bloomberg.
We never put too much weight on any individual month. This will particularly be true in this month because of the likely effect of the short-term absences from Omicron.
Brian Deese, just laying the groundwork ahead of Friday. The White House warning the jobs data might be ugly. Meanwhile, more bad news for the Biden administration on the domestic front. Senator Joe Manchin calling Biden's economic agenda for Build Back Better effectively dead. Whatever we are going to come up with, anything you want to be put on the table, we can talk about. Bloomberg's Anne-Marie Hordern in D.C. joined us for more. He did not want to talk about Build Back Better, Anne-Marie.
No, he certainly did not. For him, this was over in December, Jonathan, when he made that bombshell announcement on Fox News that Sunday that had everyone scrambling that he is not going to continue those negotiations. But he did signal that there are things that he wants to work on, especially when it comes to the tax code and lowering prescription drugs. He said that that could be, quote, extremely doable. So maybe not Build Back Better in name, but some of those chunks and those pieces the president was talking about. So that's one side of the eco agenda for the Biden administration that they're dealing with. The other is, of course, basically them coming out in plain English as much as they can, saying that Friday is going to be a bit of a dismal day for them in terms of the jobs report. And really, when you look at the analyst forecast, Jonathan, they're all over the map in terms of the non-farm payroll numbers, as low as negative 400,000 to as high as 250,000. Now, if they think this week is going to be bad, next week's inflation print, Jonathan, Barclays, Morgan Stanley, 7.3%.
I'm with you.
It's going to be tough.
I'm with you. You can make excuses up for Friday. Everyone already has. They make perfect sense. They're justified. Omicron. Chris Harvey of Wells Fargo called it the biggest sick out you've ever seen. We get it. Next week, that CPI story, north of 7. We spent a lot of time talking about geopolitics, AMH, and I just wonder how quickly this is going to transition to the domestic issues going into the weekend.
I think it certainly will, right? And you made that point this morning on surveillance. While we're all talking about geopolitics and while it is taking a lot of the oxygen out of the room of this White House, at the same time, is that really what resonates with voters, with Americans? What they want to hear this administration move on is inflation. And that Michigan Consumer Sentiment Index, 75% of those surveys, those consumers say inflation, 75% inflation is their biggest worry. And then if you look at the subtext of that, it doesn't really move much on partisan lines. So it's Democrats and Republicans.
AMH, thank you. On consumer sentiment getting hit by inflation, looking ahead to next week, it could have a 7 handle again. It could be a little bit higher. Crude right now, 88.71 on WTI. On Brent, 89.64. OPEC Plus agreeing on another gradual output increase. They're sticking to their plan. Not much is changing here. I want to get to Julian Lee of Bloomberg, who knows way more about this situation than I do. Julian, very close to a 90 print on WTI.
Yeah.
What's the latest?
Yeah, very quick OPEC meeting. The full ministerial gathering was over in just about a quarter of an hour. They rubber stamped another increase for March of 400,000 barrels a day in the target production for the group of countries. Their actual production isn't likely to rise by as much as that. The latest figures from OPEC for December show that they were already pumping more than 820,000 barrels a day below their target in the last month of last year. And that's likely to slip further as several countries can't meet their rising obligations.
Julian, is there anything the White House can do about this, the administration? They take a lot of stick for it. They tried to do something at the back end of last year. It's clearly not worked out in a sustainable way in the way that they would have hoped for. Is there anything they can do?
I think it's very difficult. I mean, the problem is that there are a very small number of countries that have significant spare capacity to boost output more. Saudi Arabia, the United Arab Emirates, maybe Iraq, although there are questions about that. But even if you're successful in persuading those countries to put more oil on the market more quickly, what that does is erode the spare capacity to cope with any sudden unexpected disruption to supply, whether that comes from a geopolitical flare-up or whether it comes from an accident somewhere. And as that spare capacity shrinks, so the market gets more concerned about its absence, and that tends to fuel the price rises too. So what we're suffering from, I think, really is 2 years plus of massive underinvestment in keeping production going, in bringing new fields into production, in maintaining output in existing fields, coupled with a very strong rebound in demand growth that at the moment appears to be outstripping supply. But, and it's a big but, if you look at the forecasts of the big agencies, whether it's the US government, the International Energy Agency, or OPEC itself, they are all forecasting that the oil market will move back into a situation of oversupply during the course of 2022. And if that materializes, that may take some of the heat out of prices.
Julian Lee, looking forward to catching up through the week on a big story for crude. It just keeps inching higher. It just keeps going. Julian Lee of Bloomberg, thank you. Looking at big tech on a move today. Alphabet up nicely, up 8-9 percentage points or so. PayPal down hard, off by 25%. You miss, you get punished. With more, here's Kriti Gupta.
Yeah, good morning, Johnny. It really is that tug of war between tech. Of course, Alphabet taking the cake as the major index contributor. And you can see on a sector basis, that's really pushing it higher. The communication sector is going to be in the lead here, of course, bringing with it the likes of Facebook, Snapchat, Twitter, even Match platforms as this kind of social network. To the downside, though, you do have energy, which is your laggard. This, of course, follows those muted returns following the OPEC meeting you were just talking to Julian about. I really want to highlight, though, that kind of divergence in the tech space, because you mentioned PayPal, but information technology, consumer discretionary, they are lagging today, and that could make or break the index. But like I said, it really is Alphabet that is taking the cake. And you can see that in the media services index actually bouncing back from a pretty aggressive correction, John.
Kriti, thank you. On a sector price action, up next on the programme, we've got to work through some central bank decisions, the ECB, the Bank of England, then on to payrolls Friday. A lot to discuss. Your trading diary is up next. From New York City, this is Bloomberg. 25 minutes into the session, equities doing OK on the S&P. Off session highs, though. I think you were hoping for more than this. Up a third of 1% on the S&P. On the Nasdaq, up a half of 1%. Nasdaq getting a lift from Alphabet, of course. Google making up about 8% of the Nasdaq 100, 4% of the S&P. Just in terms of the member weighting, that big shift higher, 8, 9% or so far this morning. Helping us out a little bit, the Russell of small caps underperform, negative 0.6%. Bond market looks like this, through 190, then we back away, through 190 last month. Right now, 176.98. Through 120 on twos, we back away. Down another 2 basis points to 114. Going into some really important economic data tomorrow. That's the price action. Here's the trading diary. A White House press briefing on COVID-19, 3 p.m. Eastern Time. Then Facebook reporting after the closing bell, followed by Amazon on Thursday. Plus, the ECB and Bank of England delivering rate decisions. Does the Bank of England go again? And can the ECB wait this one out? Rounding out the week with the main event, the payrolls report this coming Friday. 150 the median estimate. I think we're preparing ourselves for that to move lower. 250 the high, negative 400K is the low. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.